This week, we have got no fewer than 6 major central bank meetings. And of course, the biggest central bank out there, the Federal Reserve, they're making their interest rate decision on Wednesday. They are nearly 100% guaranteed to keep rates on hold, but where we're going to see a lot of volatility on the market is going to be in forward guidance, the dot plot, and what Jerome Powell and his friends have got to say. What we got last time is a slightly more hawkish tilt from the Fed. It could be even more hawkish this time, which will not go down well with the current US administration and President Trump in the Oval Office. Hello and welcome to ATFX's Federal Reserve meeting preview. This week, if anything, has the potential to be even more volatile than the ones we've seen previous. But we've got a huge central bank update, so there will be a big focus on central banks and interest rates. Top of the hill is the Federal Reserve Bank, but we've got another 5 central banks coming as well. We've got the Reserve Bank of Australia, we've got the Bank of Japan, we've got the Bank of Canada, got the ECB, we've got the Swiss National Bank, and we've got the Bank of England, all in the same week. Opportunities for trades are going to be many and varied, especially if we start to look to get some interest rate differential potential. So what we're going to do today is just go through what we're going to expect from the Fed, how that can move markets, and then just have a look at some of the technical opportunities, and there are a few out there. So first up, what are we expecting from the Federal Reserve Bank? We are 99% priced in that we will see no change from the Federal Reserve. But this is the big but. What will we hear from them in terms of forward guidance? This meeting, we do get the dot plot. That's where individual members of the Fed show where they think rates are going to be moving forward. What we got last time is a slightly more hawkish tilt from the Fed. It could be even more hawkish this time, which will not go down well with the current US administration and President Trump in the Oval Office. He wants to see rate cuts coming. Inflationary concerns that the Fed have got, first of all, with a resilient jobs market, second, with inflation, but more than that at the moment, due to the conflicts in the Middle East, started between obviously the US and Iran and Israel, inflationary concerns are huge, and that is going to weigh on not just the Fed, but every central bank committee out there. But we're focusing on the Fed. If we get a more hawkish leaning, and the market's already gone this way, we were expecting the possibility of a June rate cut coming through and more probably a July rate cut. That's being pushed further down the curve. We had some big players like Goldman's, Morgan Stanley, all coming out, pushing their expectations out to September, maybe even further. Some players even saying we may not get a rate cut from the Fed this year, and the next move could be up, especially if these inflationary concerns from the conflicts in the Middle East continue to accelerate to the top side. So how do we trade that? Obviously, if we get a more hawkish leaning than we thought, and don't forget it's already slightly priced in, the dollar should accelerate. We've seen the dollar up to annual highs already. It did see a little bit of a retracement overnight as we saw a little bit of maybe relief coming in the Middle East, but we're still sitting near annual highs, and we're sitting on some really good levels in the euro, in the yen, in the Aussie, and in gold as well. Important thing about gold as well, when we look at that chart, gold has been moving massively in line with the US dollar in the last few weeks since the conflict started, rather than as a major safe haven player. So this Fed move could see the gold move harder than we would normally expect it. Without any further ado, I'll just take us over to some charts, see what trading opportunities we've got. So first up, we're looking at the very familiar gold daily chart. Now, interesting moves in gold. As we've actually seen since the start of the conflict, gold's actually decreased as the US dollar has increased. So if we do get a more hawkish Federal Reserve, if that dot plot gets pushed out for rate cuts, expect the dollar to accelerate and gold to move lower. Now, we're sitting on a very nice trend line here and recent lows. These are the March lows down at 49.66. A break through these levels open the way very swiftly, probably, to a move down to this next longer term trend line around about 47.09. A break further through that trend line will challenge that low that we've seen back there on the 2nd of February, down at 44.00. It will probably do it for this move, but then we're all the way down, possibly to that 200-day moving average, down just above 4,000. Crazy things happen in the markets. Crazier things could happen. Now, I'm going to take us over to the Aussie dollar chart now. So this is the Aussie dollar chart. The reason I've picked this is because this has got one of the biggest potentials for some interest rate differential plans. Now, what we've got, the RBA are expected to hike by 25 basis points. The Aussie has accelerated and increased against all the major currencies over the first quarter of 2026. If we did get a disparity between the RBA, so an RBA hiking and a Fed cutting, then that would really open the way for another move topside for the Aussie, challenge these recent highs just beneath 72 and break further and even open the way up for a move to 75 cents. Now, that's probably the lower propensity move. We're guaranteed, almost guaranteed, from a similar percentage of the market is guaranteeing that we will see a 25 basis point hike from the RBA, as is a Federal Reserve hold later on in the week. So if that occurs, nothing too much. It's going to be the forward guidance. If we get a more hawkish RBA, up it goes. If we get a more hawkish Federal Reserve, down it goes. But the potential for a hawkish RBA and then maybe a not so hawkish Fed could see us really accelerate to the top side. It would be a tough one, a really hawkish Fed to take us downside. But I think we would find the Fed dominating the RBA move, as we normally do with most of the majors. So a more hawkish Fed could see us move back down. Now, the combination could be a good sell the rally scenario. RBA goes first, hikes rates, come in hawkish, takes us up to this area, allows some good selling for Aussie against the dollar. Fed comes in, they come in a lot more hawkish than expected, and it moves us back down. Just one of those things, unique trading situation in the Aussie, and that's why I brought it in. We're going to have a quick look at dollar, yen, and euro. So here we are on the, once again, familiar daily dollar yen chart. It has been a sharp appreciation for dollar yen over the last couple of months. And as we all know, a lot of this has been the dollar move dictated by what we've seen in the Middle East. Many people were looking for the yen to come in as a haven play. In a similar aspect to what we've seen with gold, it has not occurred. The dollar has moved forward and it's moved higher faster. Now, the interesting thing, of course, playing the dollar yen is we are entering what some people have called BOJ intervention level. We're calling it that because of this dramatic move down that we saw in January. We know they were checking rates during the New York time zone. So potential for trades here, probably more to the downside. So if we get a less hawkish than expected or a dovish Fed coming through that looks that we're going to get some rate cuts in June and July, and as I said, it's probably not a high chance. A break of these lows here, and I'll bring it into a little bit tighter perspective for us. So here's the trend line coming in at the moment around 158.80. A couple of days along, we're going to be around 159. Near this low 158.96. A break there opens a nice move for the way down to 156 and then further to just north of 154. Conversely, of course, a more hawkish and a strongly hawkish Fed could see us challenge the magic 160 level. Highs here, 159.74. I think it's 159.74 2 days on the row. Yes, it was. Challenge up to one. Could be a quick mark, but you'd have to be on your toes in case the Bank of Japan aren't happy with that move and they knock it back down. So dollar yen, great trading opportunity. Let's have a quick look at euro. So here we are on the euro daily chart. Now, I've thrown in a horizontal line. I don't normally do that, but this was the low we saw. It's like a triple bottom back in August 25. And as you can see there, it comes through at 113.89. And we based out here over the last couple of days, not far away from that, just around that 114 level. Bit of a rally overnight, but really the dollar's still dominant. So once again, more hawkish, strong, moving the dot plot out for the euro. Expect the dollar to get bought. We'll test this trend line coming in 114.21. As I said, lows around 114.10, and then this triple bottom from back in August, 113. A break of this area here. We've got three reasons from a technical perspective that maybe it should hold. A break there really does open the way. Then we're looking for these lows back here. That's down at 112. Could be a very swift 200 points, and then all the way down to 110. Conversely, of course, a much more dovish than expected Fed that stays in line with where the White House would like it. And the market had previously been pricing in before a lot of the data came through and the recent Middle East conflict, sees the dollar get hit, euro rally up, initial resistance now coming in on this trend line around about 116.80, as is the 200-day moving average. So euro very interesting because we've got both sides we've got decent technical levels and decent reasons. So three different levels on the downside for euro and 2 on the top converging at the moment, round about that 116.76 and just underneath and just around this 114 level. So plenty of trading opportunities coming up, especially if we're close to those technical levels. So good luck with your trading. If you need anything from us at ATFX, please let us know. And thanks very much for tuning in. Cheers.